It's a real privilege to introduce employee ownership to you as a business owner, or even to you as part of the wider advisor community. I really think and hope it will become the third key exit route for business owners. So trade sale, management buyout, and sale into employee ownership. So that's my real wish, and I'm sure it's Val's one too. So thank you so much to Val for inviting me to speak. I think Val has got a really unique view on employee ownership, having sold her business, Rooflight, into employee ownership in 2019. And I know Val is already acting as a great mentor, and she is a very good potential trustee for any business that's considering the transition into employee ownership. So do please think about Val in that capacity. Little bit of background about me, please. First of all, I qualified as a chartered accountant back in 1989. After multinational and private and even private equity-backed FD roles, I had 3 years as a PLC finance director. That came to a very traumatic end. Was really blessed by amazing Christian friends who mentored me and helped me to get back on my feet again. I started my own business as a result in April 2003, forming Vfdnet in 2004. We're now up to 23 associates. We've got 15 virtual finance directors and 8 virtual finance controllers. And I'm really pleased that several of them are on the call today. So welcome to them, and thank you for them. Thank you for your attendance. In terms of fundraising, I've been blessed with having helped clients raise over 30 million, and with over 25 deals completed. Of those deals, 20 have been of the like of trade sales or acquisitions, and roughly the last seven have been either buyouts or sale into employee ownership. And the valuation range there has been at the smallest down from 250,000, just 250,000 pounds, up to 10 million. So that's the range I've been dealing with. Let me share my slides after that introduction. Right, so hopefully everyone can see that. So onto the agenda. So today what I'd like to cover is the business sale routes, an overview of those routes. We'll then look at the deal process, comparison between two routes, the buyout and the sale into employee ownership. Got 2 slides on valuation. We'll then look at the consideration, particularly consideration timings and funding. We'll look to communication, talk about communication of the deal, that is, due diligence and completion. So onto exit routes. Business owners all have this as a consideration, and the potential routes are IPO, float, perhaps family succession, maybe a trade sale, management buyout, and sale into employee ownership. However, for most people, basically those 3 options, IPOs not really on the picture as part of the picture, family succession may not be appropriate, and trade sale may not have worked or may not fit the objectives of the business owner. So then we're really left with the management buyouts and sale to employee ownership as being the two key routes left. So a quick poll question for you, please. So if you're a business owner, how likely are you to consider employee ownership as an exit route? Very likely, unlikely, likely, or very likely. If you could put a number in the chat, 1 to 4. If you're an advisor, if you could say how likely you are to consider, to advise business owners on employee ownership as an exit route. If you could very kindly add your score to the chat, that would be very helpful. I can't see the chat, so Val, are they coming in?
They're coming in, and they're coming in at 3. A couple of 4s, but we have the vast majority are 3.
Brilliant. I think I've got a little ticker at the top which says that 22 people responded, so that's great. Should we move on?
Yep, certainly. So there are a couple of 2s, but the vast majority 3.
Brilliant. So first of all, so taking you through the comparison of the deal processes. So we're looking at the buyout. So we typically start with preparation for sale. We in Vfdnet often use exit ready map as a method of doing kind of soft due diligence at the beginning. So preparation sale, we then move on to negotiation, arranging funding, due diligence, the sale and purchases agreement, and completion. And then typically only communicating right at the end. That's always been my mantra in all the deals I've been involved in up to employee ownership, has been to communicate only right at the end. So by comparison, the sale to employees, yes, you get the preparation is absolutely essential at the beginning. Then you really move on to the business valuation model, arrange the funding, and typically communicate at this level. So you're communicating much earlier than you would in a sort of traditional deal, a trade sale or a buyout. Then you move on to perhaps a more formal valuation report, and then the due diligence will kick in, either driven by the funding or a sort of reverse due diligence. We'll come on to that a bit later. Then moving into the legals, the trust deed and the sale and purchase agreement. And then actually it's only really right at the end, typically, that the trustees are actually appointed and completion happens. So moving on to the valuation. So what I've done here is concocted an example for you. Hopefully you can all see that. So looking at the years 2018 to 21, you got sales starting off 900,000, increasing steadily up to 2020. 2021, I'm thinking this company probably would have expected to achieve about 1.2 million turnover, but 2021, year to January 21, clearly was impacted by COVID fairly majorly. So then you can see the sales coming back there to 900,000. So against perhaps an expectation of 1.2 million. Gross profit pretty well in line with that trend. So dipping down in 2021, applying the overheads. So you can see a steady increase in overheads over time, which is very typical. And then in 2021, that has been reduced by perhaps this company claiming furlough, so it has benefited from furlough. But as a result, your post-tax profit is on a steady, nice trend up till then. But then 2021 is been impacted badly by the pandemic, very typical for many businesses. So as a result, you're really faced, in terms of valuation, you're faced with the prospect of either adjusting 2021 for the effects of COVID, which would really involve trying to say, well, what would the sales really have been? So increasing the sales, and then thinking about the overheads and saying, well, we've benefited from furlough. This company's benefited from furlough, so we need to add that back in as a cost. And so arriving in an adjusted post-tax profit. Perhaps in many situations, one might not choose to do this. You might actually say, choose to discount 2021 completely. And then as a result, you might want to bring in an extra year. So 2022, in this case, year to 31st of January 2022. And it's a forecast. So there's a real necessity for the forecast to be realistic. In this case, the company was looking for 1.2 million in 21, and so 2022 at 1.3 million is not really unreasonable. Then you're projecting through down to post-tax profit. So that's what we're looking to do. Once we've achieved, brought the result down to post-tax profit, we then make adjustments. Many SME companies will be paying directors minimal salaries and rewarding the directors through dividends. So we typically are making a market value adjustment for directors' salaries. We'd also at this stage adjust for any exceptional income or exceptional costs that we're going through, which might be otherwise distorting the figure, to arrive at an adjusted post-tax profit. So the key points to think about on this sheet, think about the mindset of the buyer, even think through who the buyer is, which is an interesting one. How to normalize the results for COVID, for lockdown and COVID-19, and the importance of a really realistic forecast, and if you're going to bring a forecast into the valuation. So picking up the line that we had before, adjusted post-tax profit, then what we're doing to that is we're applying a weighting. And I mentioned that perhaps in this situation, we've decided to discount 2021 completely. So applying a zero weighting to that year and effectively saying we're going to look at 2019, 20 and 22 to produce a weighted average post-tax profit. And that's the figure there you've got there, just under 140,000. Then to that, you're applying a multiplier, a profit multiplier, 4.7 in this case. You're really looking for deal experience, deal evidence to justify the multiplier. And in this case, it's coming out at a multiplier of 4.7. So you get a profit multiple as part of the valuation of 656. And then what we're typically looking for is the adjusted excess net assets. I've seen some valuations which have included the full net assets of the business in at this stage, and I think that's actually incorrect. I think that's wrong. I think really it should be just the excess net assets, which I'm typically would define as being the lower of cash that's available for distribution and distributable reserves. So that's how I define excess net assets. So in this example, it's coming to a estimated total valuation of 862. In the case of employee ownership, sometimes, and I do stress sometimes, a discount might be applied to that sort of headline valuation. So it does really depend on, every situation will be different, but some business owners do choose to say, well, actually there's a tax benefit of doing the deal, say, into a 51% employee-owned trust. That benefit is a 10% capital gains tax benefit because you're paying zero capital gains tax. I might want to give a 10% discount to the business, to the acquiring employee ownership trust as a result of that. But it is very much discretionary and canvassing opinion within employee ownership and the employee ownership fields. It's yeah, some people use a discount, some people absolutely just wouldn't consider it whatsoever in terms of advising people. So a little bit of a controversial one there. So things to think about there, that how you're going to weight the actual profit, the multiple you're going to apply, and whether an EO discount is relevant, which is really down to a personal choice of the business owner. So moving on to consideration and funding. On completion, typically the amount of consideration that's paid out on the deal completion will depend on the amount of cash that's in the business and potentially any external funding that's brought in. Otherwise, we're typically looking at a deferred consideration period of somewhere between 5 and 8 years. So again, comparing it, say, against a management buyout, you perhaps might look at 3, maybe 4, possibly the outside 5 years as a deferred consideration period, but employee ownership would typically be somewhere between 5 and 8 years. So it's a longer time period. So the owners have to be more patient for their cash and actually trust the legacy team with the business to actually generate in the future for them to be paid out, indeed. And indeed, the consideration would typically, if you're going to bring in external funding, the former owner's consideration will be subordinated to any external funding that's coming in. In terms of external funding, it's quite important to note that the funders should not expect any new equity to come in at this juncture. There will also be a lack of personal guarantees, but it would be subject to bank covenants. And I am pleased to say that niche funders are coming into the market and are able to do deals. I'm currently working on one situation where I'm really pleased and blessed that we've got 3 indications of funding at the moment, indicative terms on 3 funders, and that's for an amount of funding of just a couple of $100,000. So really comparatively small lending. In terms of communicating the deal, I think it's important to think through just how that communication process is going to happen. And what I mean is I think it is very important to communicate the actual transaction. So not only the amount, but the valuation, how that valuation has been arrived at, how the valuation is being paid out over time. And then typically this would be a sort of communication cascade, starting from the leadership team or management team, through the sort of management level, and then through to all employees. I think it's really interesting, and in working through certainly the valuation. Sometimes I like to think of, and I like the business owners to picture the most difficult employee in their team, and to consider that person and put their image in front of them and think, well, okay, we've got to communicate this deal to that individual. How are they going to take it? What's their reaction going to be? So you can get some really surprising questions when you communicate the deal. But it's quite. I've been quite surprised by how switched on people are, and switched on to the deal, and as to whether the valuation, whether the deal is a fair one. So it's really, really important to think all that through as you're going through the process. Due diligence is typically, if a funder is involved, then due diligence may be required by the funder, or the funder might require to see sight of any due diligence that's going on. In terms of otherwise, if there's no funding requirement and no external funders brought in, you might say to yourself, well, why is due diligence required at all? But surely it's a deal. It's a deal between the owners and the new employee ownership trust, the EOT. So it's a sort of private deal. So why would due diligence be required? And I think the answer to that is that if you want to have on your trustee board good independent trustees who are going to be in the best work for the best interest of the strategic interest of the business moving forward, then I would put it to you that probably one of the worst things to happen would be for a trustee to come in and then say after 6 months or 12 months, something would come out of the woodwork and they'd turn around and say, well, you didn't tell me about that. My goodness. If you told me about that at the beginning, I wouldn't have signed up to this. And that for me would be a complete nightmare. So the need in any deal like this, you would have warranties, similar sort of light touch warranties as per a management buyout. But then you have typically the disclosures against those warranties, the sort of what I would call reverse due diligence. It's interesting that in doing employee ownership deals, is probably the only time I've ever gone back to the EO corporate lawyer and said, and actually requested new warranties that he or she hasn't drafted originally, because I actually would like the business to disclose against those warranties. So that's quite unusual, but a very good and thorough process to go through. So then we get to the completion meeting. So right at the end, where typically directors might be appointed to the trading business if they're not already directors, and trustees would get appointed only at this completion meeting. So really very late in the day. So you know, who is the negotiation being with up till that point? Possibly the trustees, maybe in a quasi sort of shadow trustee capacity, but they're not trustees until that completion meeting, typically. And then you get the legal agreements which have been worked on in the last few months, the trust deed, the share purchase agreement, and the shareholder, obviously the shareholder agreement, if that's appropriate. And one of the ways to think through this is that all the perhaps if you were in a trade sales situation, then the legals, the share purchase agreement will be the one you'd be haggling over and arguing and negotiating very tightly. I think probably it's fair to say that with a transition into employee ownership, all that energy can be moved from the sort of the more contentious share purchase agreement, where you're arguing over how you might define an earnout, how you might what conditions, whether breach of warranty might come off a deferred consideration or whatever. You can take away all that angst and make the share purchase agreement relatively straightforward, and then actually all the real effort and energy can go into the trust deed, which is far more positive about the future governance of the business, the future strategy. How do you embed the values? How do you keep the values in the business? How can we keep the leadership accountable to those values in the future? So that's where the energy typically shifts. And the cost is roughly comparable between the two, which is very good. So then we get to the completion and employee ownership day. A quick overview from our point of view in terms of running employee ownership projects. We would typically start with one of our diagnostics called an exit ready map, move through to preparation for sale, financial modeling, designing the framework, and then we get to the, as I've mentioned earlier, the business valuation model, and then typically you're getting the specialist employee ownership lawyer being appointed, his or her work being scoped. Unusual for a deal, I would suggest you would to harvest or to harness the real benefits of a sale into employee ownership. Then you really do want to think about how you're going to engage with the employees, how you're going to bring them on board. So actually to bring in an engagement advisor is a really wise thing to think about, and potentially will make a huge difference to how that deal actually lands. So then we typically have a funding tender, trustee selection, communicating the sort of maybe the more formal valuation report, reverse due diligence, legals, and then completion meeting. So I think, yes, so exit ready. So our main interventions tend to be the exit ready map, business valuation, funding, and due diligence. And very often we're actually asked to help project manage, because if the project management is quite a significant task, and as many business owners find, during the deal, they could easily become distracted by the deal. It's probably the biggest deal they've ever done. And the prospect of deal distraction and then the business going off the rails, not achieving its forecast, is comparatively high at the juncture. So it's a real risk. So that's my presentation. So over to Val.
Thanks very much, James. And we've already got a question in the chat, which we'll come to after a couple of slides. I just wanted to let you know about some of the benefits of employee ownership. I'm actually on the Employee Ownership Association Membership Council, and you'll see the logo for the Employee Ownership Association up in the top right. You'll be familiar with these people: Wallace and Gromit, Aardman Animations, Richard Sounds, and John Lewis, which are all employee ownership trust structures. And so these businesses, along with many others, and in fact, I'm told 1 in 20 in 2020 were actually 1 in 20 of the deals associated with any private business sale were actually employee ownership trusts. So the benefits of this are that you have enhanced people performance and enhanced financial performance. So firstly, 80%, and this is a survey done a few years ago, it must be said, 80% of employee owners are happy to recommend the business as a place of work, and that 80% get a sense of achievement in their jobs. And I would say that when we've done surveys like this in the Rooflight company, we get even higher results, I'm pleased to say. So there is a sense of engagement, and this is a big buzzword at the moment to achieve that, particularly in these times of people working from home a lot. So if you feel part of something special, something positive, then clearly you are going to get a higher level of engagement. And then next slide, please, James.
All right, thank you.
in terms of the productivity, the sales, and the performance overall of businesses, this is again something compared to these figures were taken from a study which was just before the pandemic started in 2020. So we have a situation where the RM2 and Leeds University came up with these figures showing that sales went up by quite sorry, I'll start off with the combined sales. That's right. This was from the top 50 of employee-owned businesses. They were up 4.3% compared to 1.2 in the UK economy. And what was significant and particularly interesting just before COVID was that 66% of businesses that are employee-owned had no debt. So you can imagine the benefit of having no debt in the organisation and cash available when times get tough. And then lastly, productivity was up 6.9% compared to -1 in the economy. So that proves that the employee-owned sector is one which is very successful. And that's why I think the government are still tolerating the capital gains tax exemption, because they wouldn't be doing this. The tax man doesn't give out things without something going back. But they see employee ownership as a great benefit to the UK economy. Next slide, please, James. Finally, I just wanted to highlight a webinar I'm doing. If you wanted to know more about the process from the point of view of the business owner, which I was back in 2019, if you want to know about some of the milestones in that journey, I'm running a webinar on the 25th of May. So if you just go to my website, you'll see that on the events page. But I would point you in the direction of the Employee Ownership Association, which gives a great deal of resources for anyone who's interested in employee ownership and who's looking to transition to an employee ownership trust. Thanks, James.
Well, thank you. So if you'd like any more information from me, I've got a free to you employee ownership white paper. So if you'd like that, I'd be very happy to share that with you. If you'd like to book a call, very happy to book a call and answer any particular employee ownership questions you might have. And do connect to me on LinkedIn if you'd like a copy of the slides. So that's us finished in terms of the formal presentation. Ahead of time, Val.
Ahead of time. Wow, that's very impressive, James. Very impressive. So I'll just remove that.
So I stop sharing.
And stop sharing. Yeah. Excellent. So we have some questions in the chat. So Mike is asking if it's not is the relative cost of what is the relative cost of employee ownership versus other exits?
So I would say it's broadly similar. You end up. I refer to the legal costs in my presentation, and so the legal costs that would otherwise have gone into the negotiating that sale and purchase agreement go into the into the negotiating the trust deed typically, and getting the governance right for the future, the governance structure right for the future. So I think I would say that the deal costs are broadly comparable. The new cost coming in clearly is the employee engagement cost. So that you could consider that's a small extra cost. However, the benefits of that are huge in terms of starting to get as Val was mentioning there, an organisation which is really gunning for the greater good for the company, rather than sort of acting just purely for themselves. So that there's a real sort of Val, is it called? I think there was a paper at one stage called the employee ownership dividend, wasn't there?
Yes, that's right. Yeah.
Which was all about sort of harvesting the benefit of employees coming into this new ownership structure. But that doesn't happen on its own. It's got to be carefully positioned, and employees can be very cynical and very skeptical about that, and so they need careful briefing and careful explaining to make that work.
Thanks, James. So the next question is from Gareth. Is there a minimum percentage of shares that need to be sold to employees?
So two answers there. Conscious that there may be some lawyers on the call, so I'm sure they can correct me. But if to qualify for the zero capital gains tax, then there needs to be a sale of 51% into an employee ownership trust. But other deals are available in terms of there could be a transfer of shares, a sale of shares into employee benefit trust, where that tax benefit does not apply, and you would not need to achieve that 51% threshold. So basically 51% into an employee ownership trust ticks the boxes from a tax benefit point of view. And I should mention this, I'm slightly coy about tax benefits, but there's clearly tax benefit to the owners in terms of zero capital gains tax, but there's also a benefit in terms of the employees, because post-deal, each employee can get paid out up to £3,600 per annum, free of PAYE, not free of NI, I'm afraid, but certainly free of pay or PAYE. So that's pretty good news to the employees too.
Yeah. And I just wanted to point out that there's no direct, in the employee ownership trust model, there's no direct shares given or sold to employees. In John Lewis, for example, it's 100% owned by the trust. In our case, in the Roof Light Company, it's 60%. But apart from Pete and myself owning 40% of the business, there are no other direct shareholders. And that's the model of the trust.
Yes, interesting, Val. I'm doing with some other clients where direct ownership is a factor, so that's certainly possible. If you've got certain key individuals that still would favour direct ownership, then that can be woven into the situation. Again, thinking through that 51% threshold, or I think it's strictly speaking over 50% threshold needing to go into the EOT. So within that, you could certainly still consider bringing other direct shareholders in, which might be brought in, say, with an EMI share option scheme, etc.
Yeah, absolutely. There can be a hybrid. Yeah.
Hybrid. Yeah.
Okay. And so a question from Mike: what's in it for the funders?
What's in it for the? I think you should answer that, Val.
Well, I suppose that.
So the funders, not the founders.
The banks.
The banks. Sorry, the banks. Yes. So for the funders, it's a really great chance to partner, I think, with some very special businesses that are being set up for the future. When I had the privilege of working with Val and signing off the trust deed, the trust deed was for 100 years.
125.
125 years. Wow. And that's quite humbling, really. So I think from a funder's point of view, it's a great opportunity to work with some really good businesses, some good businesses that I think have better opportunity to really thrive in the future. Though of course they won't all thrive in the future. Bankers are absolutely aware of that. But I think the odds are better because you've got the employees on side. It's more likely to be a more unified business and acting in harmony and than perhaps a more traditional deal, buyout or a trade sale.
Yes, and I think that the statistics actually and the data back that up. The fact that the other big aspect of employee-owned businesses is they tend to look to the longer term and not the short term. So the next question is, are the management team involved in the valuation process? Can they challenge the value?
I would say that they're not typically involved in it, but I think the person doing the valuation is always mindful of perhaps the most vociferous member of the management team or most vociferous employee. Have that person in mind when you're driving the valuation model. I would say that I think that would be my approach.
Yes, I suppose that from our point of view, when we had the valuation done, and Steve, Neil, you're here, it was Shaw Gibbs who actually did the valuation. And we wanted it to be fair, robust and defendable, which it was, and we were satisfied with the valuation, and in fact pleasantly surprised at the level. So again, it's about this willing buyer, willing seller relationship, which you just want it all to be fair, and you want to be able to go away from the deal thinking, okay, that was a good deal for everyone involved. Because you don't want to rip off your employees, that's for sure. I think that wouldn't exactly be in the spirit of employee ownership.
I think it's the sort of whites of the eyes test for me. It's, you know, sort of sitting in front or standing in front of the most difficult employee and seeing the whites of the eyes and actually being quite happy to talk through the valuation and how you arrived at it, and justifying it and being happy with their response. Yeah.
And in fact, we chose, or Peter and I chose to share the valuation, and James actually did presentations in groups of 10, and I decided not to be in the room. But I think you were quite pleasantly surprised, James, by the response to, you went through all the figures, exactly what was happening. And we just wanted, in the spirit of openness and transparency, we decided to do it. It was a little bit of trepidation on my part. I was thinking, just not sure how we're going to get, what reaction we're going to get, but it was positive, wasn't it?
It was. I mean, there was one chap. So I communicated the deal value and everything post events, or post the actual deal itself. So on the day of the deal, we had a employee ownership party, and there was one employee that refused to attend this. He was very, very cynical and just didn't want to have anything to do with this. This guy was then in this seminar, in this workshop, as I was explaining the deal, and he was my number one, Mr. Awkward, and he came out and, you know, he thought the whole valuation was very fair, and that it was a very fair situation. So that was a fantastic result. Really good.
Yeah. So the next question is from Jay, is how does it work if you have a team of associates?
That's an interesting one. I haven't had direct experience of that, Derry, yet. However, I know that has been that trail has been already trod. In particular, there was, in fact, I think on the slide Val had earlier, Aardman Animations was on there, and Aardman in particular had a range of employees and also associates. And Aardman's concern at the time was that the 3,600 tax-free amount that I mentioned before that's eligible to employees, Aardman's concern was that that would not be eligible to associates who weren't employees. And Aardman's did, via their lawyers, their specialist EO lawyers in Bristol, they did manage to get that negotiated with the revenue that the associates did qualify for that same tax-free benefit. So yeah, it's good news.
Yes, and in fact, 50% of EOT deals at the moment are for professional practices. So architects, lawyers, accountants. So quite a large number of EOTs are actually are going through from a professional practice point of view. So this is a question for me from Ruth. How has the culture changed after EOT? I'm going to be attending the Board of Trustees meeting. I'm on the Board of Trustees, along with 3 independent trustees and 2 co-owner trustees. And I'm going to be finding out from the Voice Group, who are our representative body, what has actually changed. When I asked Steve, our managing director, what he felt, he said, not as much as I'd like. And that was actually because of the pandemic. So what happens is it's a bit of an evolution, not revolution. You can't suddenly have everything singing and dancing in the first year or the first couple of years. But what I will find out, so I'll be able to tell you, Ruth, from after the meeting on Thursday. Jameson, you stayed on, because I obviously, after the first year, I was no longer there. But James, you were on the board of directors. What would you say? What did change in your view?
Yeah, I mean, I think it was really, really interesting. It's a kind of topsy-turvy world particularly where members who before were middle managers and maybe employees, seeing them being elevated onto the trustee board, and then being part of the leadership team presenting to that trustee board. So you're presenting to junior members in the company. That's a weird feeling. Really, very very good, and yeah, sort of takes 360-degree reviews right to, right to the nth degree, I think.
Yeah. Yes, I think the powerful nature, what I would say is an absolute minimum, is to have employees on the board of trustees, and these are directors. These are, they are proper directors with every right to challenge their boss, who is the managing director. So that's very powerful, as well as having the voice group who are acting as the voice to the employees as well as from the employees. So that's a good thing in itself, a really meaningful representative body. But I think that to get the real richness, I think it will take about another year to really get that a real sense of ownership, especially in these times of pandemic when people are working from home. So the next question is from Jill. If employees are not paying cash for shares, what is the downside to them of this scheme?
That's a good question, Jill. Thank you. There's no real downside to them at all. It's all upside. But it's actually, employees can be a very cynical and skeptical lot, and they don't quite believe it necessarily. So it does need to be communicated very carefully and very thoroughly, allowing sort of plenty of, and hence sort of bringing in an employee engagement specialist. We used a guy called Jeremy Gadd, who's very good. He was ex-John Lewis, and to allow plenty of time for questioning, for the employees to question the owners, me, other directors in the business, and their line managers. So as the communication cascades down, so plenty of time for allow time for questions, and let the message sort of settle steadily.
For Ryan, I trod on him and he scooped it on.
David, I wonder if you could mute your microphone, please. Thanks very much. One thing I would add to that is the fact that employees, that we talk about naked in, naked out. So that's the benefit of the employee ownership trust model, is that you don't have the complication of direct ownership shares, and you don't have and then you don't have to worry about when they leave. So that's the advantage. I'm just wondering, so I think we have David on featured on here. David, I wonder if you could mute your microphone, please. That would be great. One final question is, I think it's the final one, from Michael. Can any company bonus scheme qualify for the tax-free 3,600 per employee?
Sorry, Father, I missed that again. Sorry.
Hold on. Can any company bonus scheme qualify for the tax-free 3,600 per employee?
Okay, so for the bonus to be qualifying for that, there's a test of equivalence which needs to be met. So no, whoops. Bill, sorry, could you mute yourself? Bill, could you mute yourself? Sorry. Sorry, I got some problems.
Yeah, just a couple of, I think, Bill, I wonder if you could mute yourself, please.
Thank you. The rules of equivalence mean that you need to treat every employee fairly. So you can, for instance, you can pay out a bonus at a fixed percentage of salary. You can have rules around certain people qualifying depending on when they've arrived in the business. So if they've arrived in the last 6 months, you could exclude them, things like that. So there is some flexibility around that, but basically, yeah, if you apply sort of objective test, is the bonus objective rather than subjective, and then look at the specific rules involved, but there is some flexibility there.
Yes, it has to be on the same terms basis, because we had a profit share before becoming employee owned with different levels of percentage of salary for different levels of people, but that's not allowed within the scheme. So it has to be the same percentage throughout
Across the board. Yep.
But it doesn't have to be the same amount. So that's the general rule, I believe. So would anyone like to shout out a question before we end the webinar? Has everyone got their burning questions off their chest? So in that case, then I'll just thank you all for coming. And if you want to know anything more, obviously you've got our contact details. But have a wonderful day, and yeah, get out in that sunshine if you can.
Thanks very much, everyone. Thank you for attending. Bye.
Thank you. Bye. I'll just stop.